Okay, so yeah, we've heard plenty of good tips from Tony and Mandy, particularly Mandy in regards to the tax aspects of owning a property, and then Tony as far as buying and some of the good areas and that to invest in. So I've got to keep listening to you, but we've got to keep moving along. So how do we actually go about and buy a property? I'm sure plenty of you are interested. Traditional path, of course, you can borrow, which many of you have done. Try and pay it off as quick as you can, build the equity, leverage into the next one. You don't claim as much as you can from a tax point of view. It gives you leverage to get into the second and third property. Alternative option, of course, we can set up a self-managed super fund. So your existing super that you may have, whether it's an industry fund, might be with AMP, ING, we can roll that over, of course, create a super fund. If you've got enough money, you've been working for a number of years, you've got enough money, of course you can go and buy that property outright. If you don't, might only have 100, 150 odd thousand in your super, we can use that to set up a fund, pay a deposit on a property and then borrow. And that's what basically I'll be going through and talking about tonight. So, and then as you contribute into the fund, salary sacrifice, you've got your contributions going in, you can then renovate, develop, do all sorts of things. So I'm going to touch on a few of the technicalities of that side of it. Okay. So just, before I get started though, I've got to cover off the legal aspects of it. So at the moment we have a licence through Count Financial Group, so I'll just spend a couple of minutes on that. They're now owned by the Commonwealth Bank. Everything that I do from a financial planning point of view has to be licensed, so none of the accounting side of it falls under Count's licence. So it's just purely through the financial planning. So this is general advice, of course. We want you to come and seek advice if you're looking at doing anything in particular. So who is Count Financial Group? They were Australia's largest independent financial planning group for many years. They were around since 1980. Last year they were bought out by the Commonwealth Bank. So we're not being forced to, of course, use their products, but there's certainly an encouragement to use their products. But we have taken out them as a franchise a couple of years ago. So it's purely our business decision to use them. That's currently under review. We're not happy with the Commonwealth Bank arrangement, so we want someone that is independent. So even though they are a division of CBA, got a lot of money under management, we specialise in self-managed super funds and accounting side of it, so we want to promote that. So as things progress, we'll certainly keep you posted, and we're well advanced with changing that licence, but at the moment we're through Count, and it is general advice. Alright, so what is a self-managed super fund? There is plenty of clients in the audience who have already got their self-managed super fund set up, but for those of you who don't and who don't understand, it's effectively a trust set up by accounts to hold assets on behalf of up to 4 members. So it's effectively a family fund. We have to report annually to the tax office like any other entity, business or individual. But when I say the the super fund, a lot of people, and that's my preference to call it rather than self-managed, is because a lot of people get advice from accountants and financial planners to help them through it. So effectively they don't manage it themselves. They do rely on us, but we do have clients who do manage it completely themselves. But huge area, there's 490,000 funds now in Australia. The total superannuation industry is now 1.3 trillion, and there's 450 billion in assets inside in super funds, in self-managed. And the main reason that people do set them up is purely for control of their own money. So we've gone through the global financial crisis. I was going to say GFC, not Geelong Footy Club, but global financial crisis. So people want to invest in term deposits. They want to have their bank accounts, the managed funds. We have a couple of clients who've got gold bullion. Anything that you can do personally, property, you can do through your own self-managed super fund, and that appeals to a lot of people to do it that way. The cost to set it up, including my time, between $2,000 and $3,000. If you are borrowing, it's around $6,000. That's not any extra cost from us to do that. That's mainly from the legal costs, which I'll touch on a bit later, and around $4,000 a year to run the fund. Okay, so you can do it a lot cheaper. I've seen them advertised on the internet for $700, $800, and that's the administration is done overseas in Thailand. It's almost a sweatshop basically that they do it. Obviously, we want to do it properly, have it properly audited. So we've put together a competitive package around the $4,000 mark. That covers my time, The accountant's time to prepare all the accounts and everything as well. So, I mean, if you've got a $200,000 fund, it's effectively 2% is the cost. If it's a $400,000 fund, it's 1%. If you've got 800,000, it's 0.5%. So it's not going to cost you any more based on the balance that you've got. If you're talking $1 million plus and so forth, it may go up, but in effect, we try to keep it very, very competitive. So when you see the ads on TV and talk about industry funds and costs and so forth, you know, when you're talking this scenario, particularly 400,000, then you're spot on, almost exactly the same cost from that point of view. Okay. One of the important things to do, of course, in regards to the self-managed super fund, we've got to set an investment strategy. That's why people come and see me. Accountants can't do it. I need to replicate basically what your existing super does. So if you're with Shell or Ford or whoever it may be, and they've got you in a balance fund, I need to recreate that in a self-managed super fund. So I need to give you the advice, document that investment strategy. That's one of the main things to running a super fund, and to make sure that we're adhering to the sole purpose test, which is just keeping the monies aside for retirement. So they're the two main rules. There is 90 all up, but they're the two main ones. Okay. So from the 7th of August, those investment strategies, you just can't have 2% above CPI anymore. You can't just go and put your allocations at 0 to 100%. You have to be a lot more specific as to what you want in shares, what you want in property, and so forth. Okay, so that's why we put these packages together to make sure people get the good advice. So can you borrow money inside a self-managed super fund? Well, yes, you can. It's been around since 2007 that you've been able to borrow inside a super fund, but it was very, very strict for the first 3 years, and then it was clarified on July 2010. Basically, a lot of the rules were relaxed, so I'll go through some of these here. So one of the first ones is that it's borrowing used to acquire a single asset. So what that means is that basically you can have a property on a single title. So yes, you can just go and buy a standard investment property. It also means you can buy an off-the-plan unit, which Tony was talking about, and also a house and land package. Okay, so that's something else that's on the property side. A collection of shares of the same class as far as ordinary shares. So you can go and buy 1,000 BHP if you want, and you can set up that borrowing arrangement just purely for that 1,000 shares. But you can't go and borrow 100,000 and go and buy some Wesfarmers, some BHP, some Commonwealth Bank. You've got to set up a loan arrangement for every single purchase. It's how it works. You can do it for a collection of identical commodities. So if you want to buy that gold bullion through Perth Mint or something like that, we can certainly do it through here. Okay. But bundled assets are not allowed, so you can't actually go and buy a strata title apartment and a separate car park. So that's becoming increasingly common now, particularly in Melbourne, where instead of having the rights to the car park, you actually got it on 2 titles, where you'll have the off-the-plan unit as such, and then you've got the option to then buy a car park. So if that's the case, then we need to do 2 separate loan arrangements. Same with farmland. You know, you often find that the farmers, Western District, 60 acres, and then they get another 1,000 acres or 500 acres, and it's all on separate titles. We need an individual agreement for each of guys. Not that that's really that relevant to yourself, but just to use that as an example. Okay. With the loans, you can also use that to pay for the loan costs, legal fees, stamp duty, etc. Okay. The biggest condition of it, though, is that the asset must be held on trust. So the rights of the lender against the trust in relation to default on the borrowing. So it must be limited to the asset that's acquired. So just drawn a little chart that's here. Can everyone see that up the back? So normally, if you create your own self-managed super fund, you go and buy an asset. We do it in the name of the actual super fund itself as the trustee. So I run my own fund, Geoff and Leanne Brethouwer. So the property I've got that's in there on title, you just see Geoff and Leanne Brethouwer. That's all that's in there. So from that point of view, when you go and borrow though, we want to make sure that the assets, of course, that you've got in the fund, whether you've got other shares, other term deposits, are not exposed, I suppose, to lenders. So if you go and take out a loan from the Commonwealth Bank or something along those lines, Westpac is probably one of the better ones. we want to limit that exposure on the property, and that's why the rule was created. So it effectively has to be held in the custodian arrangement. So I would have to set up if I go and borrow for a property, I'd have to set up a company, Geoff Brethouwer Proprietary Limited, as the custodian, and that would hold the property until I had repaid the loan. And then it would shift back into then our own names as the individual trustee. So that's just to make sure that the lender, whoever gives you the money, has only got access to that property. So in the event that tenants go berserk and destroy the property, you default on the loan, they can only get that property value back. Okay, they can't come back with your other assets. Right? So if you got 400,000 in the fund and then you go and use 150,000 as a deposit, borrow another 300,000 to acquire a property, if something goes wrong with that, then not all the assets of your fund are exposed. Okay, but you still have beneficial ownership in the self-managed super fund, so you receive all the rental income. The fund itself pays all the principal and interest repayments, so the rental income's coming in, plus your contributions that you've got from salary sacrifice or your super guarantee. That's covering all the loans. So it's just purely held to protect that asset, which is good. All right. So just assuming that we've gone ahead and bought a property. So we've made the decision, we've bought our beautiful renovated delight, it's there. What now? So can the borrowings be used to fund the improvements? A lot of people think, okay, I can develop a property, I can demolish, rebuild, as Tony was talking about. So that can't be done. You can only do the repairs, and that's with the borrowings on it. So the ATO basically says you can only make good any defects, damage or deterioration to restore its function without changing its character. So basically you've got to maintain the asset purely as is. So this allows though to you basically to fully renovate a property. So if you want to re-roof it, you want to repair it, rewire, replumb, you can do the whole lot to do a full renovation on that property with borrowed funds is what allowed. So that's fantastic from that point of view. So as Tony was indicating, if you go and buy something in Herne Hill or Hamlin Heights and you want to maintain the full character of that property, manifold heights, restore it to its original character, you can borrow to acquire it and borrow some other monies to fully renovate. Okay. All right. So can other monies? So your contributions, rental income. So assume that we've gone and borrowed the money, we've bought the property, we put that in. Can other monies be used to fund the improvements? So yes, it can. So again, so long as the scale and nature of the improvements don't change the character of the asset. So what's not allowed is changing the property use. So say you go and buy something down Pont Lonsdale or Queenscliff, beautiful place, think you might convert it to a part restaurant or cafe. That can't be done. Of course, when there's a loan attached to it. Converting a single property to multiple properties via subdivision, what Tony was talking about, can't be done when there's a loan on the property. Building a residential house on vacant land, can't be done. And relocating the existing house and rebuilding. So this is important to note because whenever there's a loan attached to it, you can't do these things. But if you have a super fund and you have money that's in there, you can go and do all this. Okay, so when there's not a loan attached to it, you are right to subdivide, you can build. So as long as you've got the money that's in there, this is available to you. So this is only just if there's a loan that's in place. So what is allowed? Quite a bit, surprisingly. So even to, so the smart thing for me, yes, sure.
So can you buy some land and then build an industrial shed on it? So you can develop something with borrowed funds?
Not with borrowed funds. No. But if it's your own money, yes, you can.
Geoff, is that heading right in that case, that across the top?
To fund the improvements, yes, by all means.
Other monies, i.e. contributions, rental income, etc., be used to fund improvements, and you've got all those no's?
Yeah, well that's not what's not allowed. So you can't go and effectively develop the property, even though it is your own money that's coming in, because there's a loan attached to it. But as soon as that loan is gone, then you're right to do this. This is only whilst the loan's in place. Yeah. So it's very, very restrictive while there's a loan against it. So say we go and buy something, 700 square metres, we renovate, you know, you sit on it for 5 years, you repay it, and as soon as you repay that loan, then you're free to subdivide and do what you want to do. Yep.
Why is that risk to the, is the loan and the risk of future development? Why is that in place?
Well, basically, yeah, like the HO is saying too, that we don't want to put all that other money that's in the super fund at risk, so we don't want to keep using all this other money to, you know, to build up this asset and then to develop it. We want you to stick to it. We want you to focus on repaying it. Then, once it's a free asset, then you're free to do what you want to do. So that's as per the original rules, and that's why they relaxed it back in July 2010, because it was really, really strict. So then they just opened up this little window, and then they said, like, no, we're happy to go ahead. Yeah, so just make sure that this is only whilst the loan's in place. So,
Some question before I still do better.
yeah.
Can you have a consortium of people and develop something? So take your own cash on 3 parties, 250, and then take 750
I want to take over.
I'll get to that. Right, I'll go up there.
Yeah.
So possibly.
Yes, yeah. So, but yeah, so the smart thing from my point of view is if you go and buy a property, and we take out the loan, we bet it down, you've got your rental income, your contributions and then going into the fund, what is allowed, so you can then go and put the new kitchen in, you can go and do laundry, extensions, erecting a granny flat even, or adding in a pool. So as long as your money is the rental income and that are coming into it, you can then use that to do these developments. So it's just, we just have to be very careful as far as trying to do anything fancy with the property until the loan is repaid. So, alright. So just questions. So yeah, this is my references from the self-managed super funds ruling. I do have it here, but if anyone wants to have a look, I don't recommend it, but it is here. The limited recourse borrowing arrangements. Don't recommend you read that either. That's something for me.
Just want to clarify something, Geoff. You do all those great improvements, put the pool in, the new kitchen, besides, I wouldn't mind living in that place myself, actually.
Yeah.
What happens?
Well, as long as you're retired, then effectively, yeah, we can consider it a lump sum redemption of the value of the property, and we can cash that out of your super, and you can then go and live in it. Yeah, but it's a very delicate area. We have to, and so it's effectively like converting your preserved monies to unrestricted by retiring, and then you're taking the value of that asset, rather than taking 600,000 or something out of the fund. So it is possible, but we have to be very careful how we do it. So what happens here when the loan is repaid? So the asset shifts from the custodian trust, what I was talking about before, that's Geoff and Leanne Brethouwer Proprietary Limited, to then just our name. So it doesn't attract any capital gains tax or attract any stamp duty. What alternatives are available? You can acquire the asset with another party or another self-managed super fund. So a friend and I have actually bought some land and that together, so we've done it where we're 50-50. Because it's our money, we can now subdivide that. So you can do it 20, you can have 5 lots, you can, different people. You can have a self-managed super fund that owns half, you can have someone in their own name who owns the other half, as long as you're not taking borrowed money against it. Okay? So if you're not comfortable to borrow and you want to develop, you can still juggle it so that your super fund owns half or that you own half. So there is lots of different alternatives available. So, but look, I've just touched on it. I've given you a bit of an idea as to what you can and can't do. We'd love to see you come in, obviously, and get some advice, and we'll run you through it. Talk to Mandy first, then Tony, and come and see me, and I'll tell you how we can structure the deal to make it happen. But I'm starting to get a lot of inquiries in regards to this, because a lot of people do have money in super, do want to be in property, and do want to make the most of the opportunity. So without taking a whole lot of risk, we still get some good property exposure. And we're very fortunate in Geelong. There are a lot of good properties that are sort of 300 to 500,000 in value. So without over-committing, you can certainly buy some good properties. So hopefully it's giving you a little bit of an insight into what can and can't be done. Plant a bit of a seed there, some thoughts, and then come and talk to us.
So are there any further questions for Geoff or anyone? Yes?
Geoff, you may have mentioned it earlier. There were some recent changes, or proposed changes in regards to cost or tax or levy surcharge or something like that with regards to self-managed super funds?
The main one was just on the 7th of August. That was the investment strategy. So what happens is when we set up a fund, the default is what we create as a trustee resolution is 2% above CPI. And look, we've had people that have opened, since 1995 and so on, and they review them every 5 or 6 years. So the tax office basically come out now and said, well, no, you've got to be serious about this. If you're going to be the trustees of the fund in charge of your own money, we want you to be specific in how you're going to invest this. So you need to recreate the same strategy as if you were in a public offer fund or an industry type fund. So that's the major change that has come out. So there's now a lot of onus on you as trustees just from that investment strategy point of view. And it needs to be done every year from now on. So it's not just a matter of leaving it and, oh yeah, you're right, we'll have 0 to 100% cash. Then 1 year we'll go and put 30% in shares, and then I'm getting a bit worried, I'll back the money out. We'll go 0 to 100% cash, and we can't do that anymore. We have to be a lot more specific. So investment strategies I'm doing at the moment, 5 to 70% in cash, 30% fixed interest, a little bit of shares, a little bit of property. You can have property only investment strategies, where you've got basically 90 to 95% of the money in cash. But as long as we are specific with those ranges, and the auditor comes along, ticks it all off, as soon as the auditor ticks it off, then it goes off to the tax office, and we're good as gold.
Geoff,
Yeah.
if you buy a property for yourself, managed super fund, can you have any of your family rent it?
No. No related parties whatsoever.
Is that an exception for commercial property?
You can't have any related party or business no. So it really has to be a commercial agreement.
You could own your own premises.
So you can, your super fund can acquire it and you can pay it yourself a lease effectively. So as long as it's a commercial arrangement, you can do it. Yeah, but you can't really rent it out to existing family members as such. Is that what you're sort of angling at?
I understood that it was a commercial property, it was a different set of guidelines you could...
Oh, it is if it's your business.
Yeah,
you can lease it out, that's no problem. Yeah. Sorry, I was thinking more of family members. Yeah.
But a family member could lease that commercial property.
Oh, that's fine. Yeah. As long as it's a commercial arrangement, or when I say commercial, that it's documented and it's a commercial amount of rent or a market amount of rent.
So Jess, I might miss something, but with that, what happens when the loan is repaid and it goes back to the trustee, and if you sell it, is that you're not paying capital gains?
No, this is just once the loan is repaid and it comes back to you as an asset. Yeah, but if you had, say, use Manny's example where you've sat on for 3 years, 200,000, it's now 375. Yeah, the super fund will still pay tax.
I've got something.
Yeah, but it's just once the loan, and then once the loan is repaid, then it comes back into the super fund on